Hi there and welcome to Listen to the Market for Monday, March 5. Today's video will be in two parts. The first part will cover the price action of Monday through the eyes of the L.I.V.E setups and specifically the top-down approach. The second part will give you an update on real money, real-time trading applying these same setups. So you'll be able to monitor what results can be, in fact are being achieved by one person applying them. This is part of a project that I started last year in June, which is entitled The Experiment. It's got a lifespan of only 2 years, and I'll update you on that as we go at a later stage. So let's get into Monday's price action. Well, Monday's price action was preceded by marking in Friday's lows, of course. Friday's highs are off the top of the page. Two probabilities for Monday. Number one, expect the lows to be broken, which they were. First cab off the rank in the morning, actually the first hour of trading in the morning. Second probability based projection was expect a smaller range. So what does that mean from a practical point of view for L.I.V.E purveyors, L.I.V.E students, L.I.V.E practitioners? Well, that means don't look to roll up because the range is expected to be smaller. Manage, enter, exit on a smaller time frame, and say thank you to Mr. Market for whatever comes out. Destination unknown. The formal start of the optimal time window, optimal profit window in through there, my time, and ending there again, clearly encompasses the majority of the movement yesterday, i.e. Monday. At the lows here, there was a textbook FO buy on the 60-minute, FO buy there on the 30, and another little buy in through there, which is an SBS buy in the 15. The AA was kicking in. After the FO buy, the natural sequence on the hourly was an RTV, V for victory, as well as an RT buy. Now that's a potent combination, the combination of an RT and an RTV, as well as the sequence, the context in which it was appearing. So formally on this hour bar here, looking for a buy top-down approach, 30-minute presents an SBS buy as well as an RTV buy, so two setups, adding some more power to it, to the buy side. The 15-minute was an RTV buy, so simply plain vanilla, looking to enter at the highs through there, ISL at the lows down through there. Next bar comes along, and you can see that the high has been broken. However, because of the formula that the L.I.V.E approach applies to the entry in ISL and TSL levels, the entry was not triggered. The order remains in place for the next bar, for the next 15 minutes. Next 15 minutes comes along and yes, been filled, ISL is not being hit. Period 1 of the campaign, ISL needs to stay in place according to the rules. And emotionally, of course, you want to raise it to break even or something. The problem there, of course, is the closer you go to the current price action, the more you'll protect, but also the easier it is to get stopped out. So why not stick to the rules? The risk was acceptable back there, nothing has changed. Next bar comes along, and now the rules do allow you to raise your stop from the ISL to a TSL, locking in almost a 1 hour return. Next bar comes along, and slightly higher low, slightly higher TSL. Next bar comes along, and yet again slightly higher low. So from the initial, we've raised it up through to there, locking in clearly a 1 hour return so far. And now we're locking up a 2 hour return. Thank you very much, plus. And the market does stop you out on the next bar. So again, the top-down approach, the 60-minute in line with the 30-minute, in line with the 15, gave the opportunity for a 2 hour plus return. The pips at risk in through there were about 10. The low lows down here through there being the fake out buy, the FO buy on the 30-minute as an aggressive ambush. The SBS buy in here on the 15-minute, again plain vanilla entry through there, ISL through there, 10 pips at risk, less than, and you got a 1-2 hour return in there. So you're getting an insight into how efficiently the L.I.V.E rules, the L.I.V.E setups capture a movement. Buying in through there, exiting through there, that's capturing better than what, 50%. Buying in through there, exiting through there, again, the efficiency factor seems to be well and truly on your side. Well, that's a wrap for Monday. Next part, we'll be looking at the real money, real-time results of applying the L.I.V.E setups, the L.I.V.E campaign management, and the L.I.V money management. Back in a tick. Let's now have a look at the real money, real-time performance update of a student who's part of the experiment, the 2-year experiment that started in June last year. Using real money, trading the markets, applying the L.I.V concepts, the L.I.V rules, the L.I.V campaign management, the whole enchilada. These are the actual results over the last 2 weeks. The first thing to notice is that from the distribution graph down the bottom is that there are no multi-R winners except for one. What you're seeing is clearly not the application of the full top-down approach. At the moment, the operator, who shall remain nameless but not blameless, is in training mode. He's doing the laps around the race circuit. He's making sure that all the systems are nicely greased and in the right place before he starts going with the 60, 30 and 15. Part of the training process is to apply it purely on a 15-minute chart basis. That way the frequency of campaigns is increased, that way the training mode is sped up. So what we're seeing in terms of return, actual return for the last 2 weeks, is 7.27 actual trading versus the idealized yardstick or baseline of 7.82 R. So quite simply, if R is 1%, then 7% return on the account. R is 2%, then 14% for the last 2 weeks. Either which way you cut it, in a linear fashion, it's shaping up to be a rather interesting year. In terms of number of campaigns, 37 campaigns versus 43. Now, as you may recall, there was one Friday where it was a TGIF, where the operator did not attend for whatever reason it was. So this is the difference between the theory and the reality. In terms of strike rate, okay, well, it's 54% accurate. No big deal there, and really not a very important stat from my side. A more important stat is the number of wins in a row, where you can see that clearly there's clustering effect in there, clustering for wins and also clustering for losses. Another important stat is the size of average win versus the size of average loss. So the average win is 2.6 times larger than the average loss. So that's a nice ratio. Another aspect to bear in mind from a tradability point of view is how long does one remain in a drawdown? How many campaigns or how many days in a drawdown? This is a 15-minute approach using the optimized or the optimal time window. So 7 campaigns. So that's more just over a day being in a drawdown before a new equity high. Now the trap, of course, of looking at the entirety of the result is that you don't see the inside picture of just 1 week. And this is last week's actual versus last week's baseline, and you can see that it started out rather well, then went into a drawdown, almost back to starting point, not quite, and then the last campaign on Friday pulled it into a profit. And there again are the stats for last week by itself. The choice, of course, is yours, whether you want to be a tortoise or a hare, in for a good time or in for a long time. So each week, Monday's report will update you on the real money, real-time performance of the experiment. Catch you guys Tuesday. Thank you much. Bye for now.